Investors have been feeling uncertain about their portfolio allocations as most 401ks have been pummeled by market volatility the last few weeks. So we want to take a step back and break down how you should be allocating your portfolio depending on your age. For that, we have Kevin Justice, who is the Senior Vice President and Head of Nationwide's Investment Management Group. Good to have you here with us. So let's start with those just starting out in their career. How should they be allocating their money?
Yeah, thank you, Brad. Great question. So it's important to remind young, early investors about the importance of beginning an investment program. For many young workers, that can be achieved through a defined contribution plan sponsored by their employer. And so it's really important to think about budgeting, investing for yourself, investing for the long term is a key component of those early decisions you can make to set yourself up for success in the long term. Sometimes the volatility discourages people from beginning those investment programs. And it's really important for all of us to remind young workers how important it is to begin saving early and the power of compounding to generate long-term wealth for their long-term retirement planning.
So should young investors be putting even more cash in right now to, for what everybody has been raging about on social media, buying all the dips?
Great question. So I often remark that stocks are one of the very few things we don't like to buy when they go on sale. If I were to go out and buy a new shirt or a new hat, I'd love if it was 15 or 20% off. But with stocks, we like them to go up forever. And there's a lot of psychology behind that. But important, without necessarily calling a top or bottom in any market environment, when stocks dip in value, when the market goes down, it creates a buying opportunity. So to the extent you have discretionary cash available, certainly any dip, a discount, a sale on the price of stocks, if you will, can create a great opportunity to invest. Important, though, to remind everyone to stick to a long-term financial plan. Whether you're an early investor starting out or you've been in the markets for decades, it's really important to write down a long-term financial plan and stick to it. But market corrections and dips create good buying opportunities to get capital to work for your long-term wealth building. Now,
say you're mid-career, how should you be allocating at that point?
Yeah, so mid-career investors are often complicated portfolios by the fact they've been saving for some years, investing, potentially using 401ks, 403bs, IRAs, may have children in their family structure, have 529 accounts for them. So important to get the right accounts and the right structures for your investing and saving needs. That's an important component. The second is thinking about the asset allocation of the portfolio. For a lot of mid-career investors, the investment horizon is still decades away. Not only is retirement potentially 10, 20 plus years away, but we as Americans expect to live longer on our retirement assets post-retirement. So we think about retirement at 65. If you're mid-career in your 30s and 40s, early 50s, you want those assets to live not only to 65, but for potentially 20 or 30 plus years into retirement, very long horizon. So within our own target date funds, we have an allocation that in the early career stage is 90% equity, and then decelerates from about 10% increments throughout that mid-career stage, from 90% all the way down to 40% into retirement for the equity allocation. But again, we recommend that being a long-term strategic asset allocation and not encouraging people to time the markets per se, but important to have a healthy equity allocation through our working careers and saving and investing lives.
It sounds like this is the part of your life where things start to get a little bit more complicated, where you've got more assets, whether that be in your portfolio, your real estate, your family life as well coming together. Is this the part of your career when you should think about getting a financial advisor?
Wonderful question. So the answer is yes. For many people, there are great resources available through your defined contribution plan, employer-sponsored savings plan. You can use those to get started, financial literacy and education. But as your life and your portfolio and your needs and your expenses in your life become different and varied and more complicated, it can be really valuable to partner with a financial advisor who can tailor a portfolio and a financial plan to your unique custom needs based on your income level, your tax structure, your time horizon, and your risk tolerance. And then importantly, help you through periods of volatility like this to understand where opportunities may exist and help you stay true to that long-term plan.
Just lastly, while we have you here, pre-retirement, should you begin allocating away from stocks?
So as you're approaching retirement, we would expect there to be declining allocation of stocks in your portfolio, a shift toward more fixed income to moderate the volatility. But important, your horizon, even as you're approaching retirement, is likely still multiple decades into retirement, given the longevity of lifespans we have now. And so it's important to have that equity allocation as a buffer. That equity allocation helps achieve real inflation-adjusted growth in your portfolio over the long term. So as we approach retirement, we expect declining equity allocations, but there's still to be a healthy allocation to stocks across portfolios to provide that long-term multi-decade source of growth.